All right, this is video 1 of 2 on the loanable funds market for module 29. All right, first of all, so far we talked about the money market. And the money market, remember, is going to be the supply and demand for money, and it determines the interest rate on the short-term financial assets. Now, in the case of the loanable funds market, we are actually looking at the market for where savers and buyers go to be able to get loans. Okay, so keep in mind that savers are the ones that are supplying the money. Borrowers are also obviously the ones that are demanding the money, that are wanting the money. So what I put the where in quotation marks is because obviously it's not like a physical location, but it's going to be basically the idea that the savers and borrowers are going to be coming together to determine what the interest rate should be charged for those loans. Obviously, savers would love to charge borrowers as much as possible, whereas borrowers would love to be able to borrow money with as little interest as possible. So, keep in mind, the loanable funds market, as it sounds, is for loans, the interest rate on loans. So, businesses will only want a loan, so they're the borrowers, if the interest rate is less than the rate of return on its project that they're projected. So, what I mean by that is that so the rate of return is the revenue from the project minus the cost of the project divided by the cost of the project times 100. What this means is that, okay, if I'm going to be taking out a loan, I want to make sure that I'm going to be getting more back from whatever I'm getting the loan for. So, for example, maybe I'm getting a loan to be able to expand my business, and I'm expecting that because, maybe I have a bakery and I'm going to expand my business. So now I'm going to, instead of having 2 ovens, I'm going to have 3. Well, I'm getting a loan for this, right? So I'm expecting that the revenue that I get from making so many more cakes and pies and cookies and whatever is going to be a lot higher than whatever it costs me to buy that 3rd oven. And maybe I need to be able to, literally make my bakery bigger, expand the actual size of the business, of the building. So that could be also a cost. So when I look at the loan that I'm going to potentially be charged, I'm going to want to make sure that the interest rate that I'm charged, okay, is going to be lower than whatever I'm expected to get from, making my business bigger. So the demand for loanable funds is a downward sloping curve, just like any demand curve. Okay, so for example, at 10%, okay, so 10% interest that I'm charged on a loan, I am only going to be interested in that if my rate in return on, for example, buying a new oven, if I'm actually going to expect to get a rate of return higher than 10%, because otherwise it isn't worth my time. I'm going to get charged way more on interest on the loan than what I'm actually going to get from selling more cakes and pies and cookies. So as a result, that the demand curve is downward sloping, and it's particularly looking at, okay, what is my rate of return, what is my projected profit on my project that I'm trying to get a loan for. Now, keep in mind, this is obviously, you don't have to write that again, people are also more willing to make a loan when they get a higher interest rate. So, for example, in this case with the interest rate and the quantity of loanable funds, if I'm the bank, I am much more willing to offer funds to loan out. I'm much more willing to give out a loan if there's going to be a higher interest rate. Higher interest rate, I'm going to definitely offer more for the loan. Now, when you put them together, you're going to obviously determine equilibrium. So equilibrium will tell you the interest rate for loans and the amount of money that will be loaned out at that particular quantity. So put together your demand for your loanable funds, there's your supply of your loanable funds, here's your equilibrium interest rate. So your interest rate, R is the symbol for interest rate, equilibrium interest rate, and that's your quantity of your loanable funds. So keep in mind that just like any old supply and demand curve, now we're just talking about, for loanable funds, so we're just talking about the supply and demand of loans. All right, so if that's the case, we do know that there are things that will shift the demand for loanable funds and things that will shift the supply of loanable funds. So yes, we have more charts. Yay! So there's 2 here, and notice that it keeps it nice and simple. There's 2 factors for each. So the demand for loanable funds, the two factors that cause a change in demand for loanable funds is the perceived business opportunities and government borrowing. The supply of loanable funds is going to be changed only by the private savings behavior as well as capital inflows. All right, so take a moment, pause the video, go to your book, and you can find this in Module 29, and see what you can find there on pages 280 and 281 of your book. So pause the video, see what you can figure out. So you should have realized that the perceived business opportunities is obviously talking about the perception that business has about their rate of return in the future. So a right shift would be increase the demand for loanable funds if they think that the rate of return on future investments or future projects is going to be going up in the future. And a left shift is obviously if they think the rate of return on future projects is going to be going down in the future. Government borrowing. Obviously, the government has to borrow money sometimes for their spending because they don't want to change taxes. So, a increase in government borrowing, obviously a right shift, decrease in government borrowing, a left shift. The supply of loanable funds, private savings behavior. Private savings can be affected by a lot of different things. Keep in mind, be mindful of any time in the AP test that they are talking about, particularly in some of the free response questions I've seen, where they talk about something that changes people's savings. So for example, if financial assets increase, they're going to save less, for example. But generally speaking, a right shift in the supply of loanable funds is that if they are, people are saving more, then that's going to be a right shift because savings are going to be more available for loans. Whereas a left shift is going to be if the people are saving less. So if the people are saving less, they are going to definitely have less to offer for loans. Capital inflows, remember capital inflows is going to be money basically coming from outside the country. So the right shift is going to be if we have more money coming in from outside the country, and this could be caused by a variety of things, but basically the foreigners' confidence in our economy and what things are going on and the potential for interest gained for them. And a left shift is obviously if there's a decrease in money coming from other countries. All right, so hopefully you have those figured out. Now, keep in mind that these are going to be ones where they will pop up again, and you will have to determine, is it going to be a right or left shift in the supply or demand of loanable funds? Okay, so when the demand or supply of loanable funds changes, the interest rate and the quantity of loanable funds also changes. Obviously, as we shift the supply or demand curve, equilibrium is going to change. So here's our original supply and demand for loanable funds, our lovely equilibrium. And then, for example, maybe we have a case of we have an increase in government borrowing. So increase in government borrowing is going to shift our demand curve to the right. And so as a result, our equilibrium interest rate is going to go up. And obviously, the quantity of funds that are going to be loaned out is also going to go up. So when this is caused by government borrowing, so when a government borrowing does this and causes the right shift in the demand for loanable funds, it's going to actually cause businesses to cut back on investment spending, which is this idea of the crowding out effect. We've talked about this before. Essentially what's happening is that if you think about it, here we have, going from the red curve to the yellow curve, what we have happening is that the government is borrowing more money. So they're driving the interest rate up. Well, because they're driving the interest rate up, that's the interest that's charged to anybody, not just the government. So businesses that, for example, want a loan to be able to expand their business, they have to get charged that same interest rate. Well, because the interest rate has gone higher, a lot of businesses are going to say, well, geez, I can't afford that. So as a result, the government is actually pushing out some investment spending because of that. All right, I also want to talk about the Fisher effect. The Fisher effect basically explains the relationship between inflation and interest rates. For every % increase in the inflation, it causes an equal percentage increase in the nominal interest rate. So what does this look like? the real interest rate then is unchanged. So this is what this looks like. So going, for example, here, okay, and if, and I just used obviously a graph from the book, but here's what happens is the supply and demand for loanable funds at a 0% expected interest rate. Okay, so maybe that's at a 4% interest rate. So they're going to charge 4% for loans. Well, then what happens is that maybe something happens and they're expecting, suppliers and demanders are expecting that there's going to be a 10% inflation in the future. So if there's 10% inflation, people will build that in to that interest rate they're going to charge on those loans. So what happens is that the demand for and supply for loanable funds will increase by exactly 10%. So instead of being at 4% interest rate, it'll now be at 14% interest rate. So the demand for loanable funds at 10% expected inflation rate incorporates, okay, we already had an equilibrium at 4%, but we also know that prices are going to go up by 10%. So we got to add 10% to whatever our original equilibrium was. So now our interest rate is at 14%. So all we're doing with the Fisher effect is that we're basically taking a look at incorporating the inflation rate into the interest rate that we're charging on our loans. And it is going to be exactly the same. Okay, so hopefully that makes sense. Let me know if you have any questions. There's one last video where we're going to actually compare the loanable funds market and the money market, and we're going to look at how they determine a lot of the same stuff. All right, thanks.